following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions... Welcome to the Common Sense Investing show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. Just reminded me a minute ago, I used to say I'm the grand poobah of the Dillon Gage
investment
companies.
world.
Right.
Why not?
And I forgot some people that work here are a lot younger. They might not even know what I'm talking about saying grand poobah.
Oh, you're talking about the Kreskin from Johnny
Johnny
Carson?
It was actually from the Flintstones. Remember they go to the lounge
Oh,
and
yeah.
the lodge?
Yeah. I was thinking Kreskin all the time when you said that. No, I do remember.
That was the grand poobah. So I guess you have to be old like us.
That's right.
Because most people are going, what in the hell are you talking
I'd
about?
forgotten about that. Very good.
But that's what it was from. That's a reference.
It sounds like you're back at full strength.
I am. I'm not dying this week.
All
Last
right.
week I was a little sketchy.
Amazing what a Z-Pack can do.
Oh, it is. It's great, too, because what do you take it for 4 days or something instead of 2 weeks, and if you miss one, you're screwed, kind of.
It knocks out a lot of other ailments, too, as long as you're on it.
Remember, if you have any financial questions, that's what we made this show for, to answer your financial questions. So much of the financial world is double speak, talking about Greek letters all the time, and hopefully, and basically trying to show you how much more that they know than you know. And that either impresses you or confuses you.
And if they don't,
we'd rather not confuse you.
Exactly. And if they don't do that, what do they try to do? They usually try to scare you. And if you're ever in a meeting with somebody and you're feeling scared of the market and the situation, time to excuse yourself.
And remember our philosophy. Our philosophy at Dillon Gage, we've been in business, since 1976. And we've both Guy and myself, been doing this 30 years apiece. And our philosophy is easy to understand. We believe if you need an income from your investments, guarantee enough to cover at least your hard expenses. And so if everything goes crazy, if Putin goes nuts and starts bombing people, or North Korea attacks South Korea and all that kind of stuff, you can still pay the bills. And after that, we think the stock market is a great place for your money, after your reserve cash, of course. But the stock market, long term, is one of the very few things that beat inflation. But I'm not trusting everything that it might not change in the future. So my bills are already paid. And that's what I tell people all the time. Does it make sense to carve out a portion of your retirement funds to guarantee an income stream to ensure, no matter what happens to the market, the economy, or anything else, your bills are always paid?
And things can get crazy in a heartbeat. We've all been around long enough, certainly the listeners, to see a lot of things happen, the Enrons, the whole thing. But you mentioned Putin. You said, he buzzed our ship 30 times earlier in the week? I mean, it's crazy. Just like that.
And the message, we've been doing this show a long time, many, many years. But the message is starting to get through to a lot of people. I'm getting people they're coming in now that have been 100% stocks for many, many decades even. And they say, you might be right. Maybe I should put a little away to guarantee, no matter what happens, that I won't run out of money. And remember, the fear of running out of money is higher on people's mind than the fear of death. They've done study after study. People fear running out more than death. Now, I don't know if I'm that way, but
it's almost like public speaking, right? People would rather die than get up in front of a group of people and talk.
Oh, we've been doing it so long. It becomes second nature. Let's talk a little bit about the election, but not in the way you might think we're going to talk. We're going to talk how does it affect the stock market. You've heard many times, if you think about it theoretically, Republicans are typically more pro-business, right?
Right.
And you would think they're better if an Republican's elected to president, that it's better. Well, actually, if a Democrat was elected president, the average market return has been 9%.
Well, now, isn't that because a Democrat comes in after a Republican?
That's my opinion.
Trickle-down economics. I've heard that somewhere.
Right. Or stock market returns when the Republicans, this is since 1900.
Right.
It's been about 6%. Okay? But I'm with you. But honestly, normal variations in stock market return dwarf that comparison anyway. So that really doesn't come into bearing that much. Now, here's another myth. They say divided government. is always best. In other words, the White House being Republican or Democrat, and the opposite holding the Congress. And so they looked at this. 2 years after an election, if a single party wins both the White House and both houses of Congress and the White House, the average return has been 16.9%.
Wow.
All right. If one party wins the White House and one other party wins both houses,
right,
it's 15.6%, almost the same.
It's analogous.
The one thing that was interesting, though, if there's a split in Congress, in other words, Democrats control the House and Republicans control the Senate,
or vice versa,
the return's only been 5.5%.
Interesting.
And that's for over 2 years. So the 16.9 have been like 8.5.
Certainly of late, they certainly don't seem to be able to get along, and they're deadlock on everything. So it'll be interesting.
It's weird. The one big exception was that 2010 to 2012, when you had a split Congress and the market made 19 and 42. So that's the only time that it varied off of that pattern for 100 years, which a lot of you people out there are going, oh, this is boring. I love this kind of stuff. Remember, I used to be in engineering, and numbers are everything.
Oh, yeah.
And I just love that kind of stuff. So the conclusion to this right here is who's in the White House doesn't have that much of an effect. How the market actually did before 3 months, though, really does. Let me give you this. In 22 presidential elections since 1928, 14 were preceded by gains. The preceding 3 months, the market went up.
Before the election.
That's right.
Got it.
Before the election, it went up. 12 out of 14 times, the incumbent party won the presidential election. Now, there were 8 of them, because remember 14 it went up. Well, 8 of them, it went down the preceding 3 months before the election.
New administration.
7 out of 8 were kicked out of office. The incumbents were kicked out.
And a new administration.
Right. Exactly. That means the 3 months before the November, so what is it going to be, August or whatever? August, September? Those 3 months have predicted who's going to win the White House 86.4% of the time for 100 years.
Tell you one
Interesting,
thing.
isn't it?
One thing for sure: election years are a lot like April, tax month every year. People seem to get polarized. They don't want to move. They don't want to change, and they get less active, I think, with their portfolio. I don't think it's right because they don't know what to do and what direction to go. But if they have a plan, which we've always talked about, and they're working. That's the importance of having a plan. If you have a plan and you're working your plan, all of this other stuff is peripheral. It doesn't matter.
You get that? You've heard that term, analysis paralysis. And what happens is people, when the stock market gets volatile, when all the election stuff, people get really emotionally attached to this kind of thing. When that happens, people freeze up. I don't want to do anything. And that could be they don't want to make a mistake. And a lot of times the mistake is not doing something. So you're actually perpetuating the mistake.
Say that again. That's so true.
But it's absolutely happens all the time. And that's why it's just like Guy said, it is so important to have some kind of retirement plan, financial plan. Because if you have that plan and you stick to that plan, none of this other stuff will matter. And that's why with all of our clients, our KRLD listeners, we offer this no cost or obligation to a written retirement plan, stress test, and Social Security optimizer. Don't hesitate. Call us, and if you'd like to take advantage of it, it's 972-715-2424. You can go to ilovemyretirement.com as well. But remember, even if you decide, I'm going to stay with what I'm doing, you at least have a plan and kind of know you have a blueprint for a potential retirement down the road, or even if your retirement, you have a blueprint that you didn't have before. So either way, it's going to help you. 972-715-2424, or go to ilovemyretirement.com.
One thing that plan does, just as an afterthought, is it takes emotion out of your decision-making process. And emotion is a killer in many things, but certainly in stocks, and you want to get in and you shouldn't, and you want to get out and you should. It takes the emotion out.
Right. Emotion is a good thing in a lot of areas, but it's not good when it's managing your money. The numbers usually are better. Stick with the numbers, stuff like that. There's a lot of people giving me calls lately about the stock market. What's the stock market going to do? It's come back up. I went down really hard, and what did we go to 8, 9, 10% in January?
Did you share the answer with them, or are you keeping it close in?
Oh, I'm going to keep it.
All right, I just want to know.
I'm Trump here. I'm going to keep. I'll tell you when I get.
It's going to be great.
That's right. It's going to be
great. Just call me.
That's the one thing about this election that kills me. I don't like any of them. This has never really happened to me where I honestly don't like it. I might lean a certain way, but I really don't like anybody. I think the choices are, A, B, and I need a C choice. But a C choice usually just means you're throwing away your vote, right?
Hey, and you don't want to throw your. That's right.
Why'd you waste your time going out, right?
I know.
But the market right now, you're hearing conflicting reports. The economy's really good. Economy's really bad. It's about to be this is a trap, a classic investor trap. What do you mean a trap? It's gone right up. The China worries are starting to ease. All of these different things. Well, there's a reason for all of this back and forth. An article I read in Market Watch, I thought was really kind of interesting. It talked about this rally we've had. It looks like a classic investor trap, and we'll talk about that more after we get from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch.
Welcome back to the show. Remember, folks, if you have any financial questions, like to take advantage of our no obligation, no cost written retirement plan, stress test, and Social Security optimizer, never hesitate to call our hotline at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com.
You know, before we went to break, Victor, you were talking about a lot of different opinions on the market. Some folks think it's going up. Some people think that it's going down. And it's funny because all of them can build a good case, right? So if you don't know what's going on and you don't follow it every day and you're listening to someone go in great detail with all these facts, statistics we talked about that the market's going down, you believe them. And conversely, if you were sitting down with somebody you didn't know and he gives you all this great information, the market's going up, you believe them. So you have to kind of sort through. We're here to help shine some light on some of those things and help you through that. Harry Dent, IRA of notoriety, and he's written a lot of books, has got a new book out, and so he's making the circuit. He's on all the television shows, and he's in all the deals. In his opinion, he was saying he really thinks we're in trouble in the next 6 to 8 months. Now, I don't subscribe to Harry Dent's philosophy, but it's just another one out there.
Right.
With credentials, what do you do?
Because a lot of these people, they say that stuff, and they said it like 10 other times.
And the right ones, and say, oh, I predicted that.
That's right.
Exactly.
I heard this one commercial. I said the market was going to crash, and it did. I said this, and it did. Exactly. Well, then why are you hawking a book on the dang radio?
Absolutely.
Come on. You'd be a trillionaire already.
For sure.
You'd be able to pay off our deficit by yourself. The article I was referring to in the Market Watch was pretty interesting. It's called "Why This Market Rally Looks Like a Classic Investor Trap." All right. It says that I'll read a couple excerpts from it. Nowadays, in a world of high-frequency trading and speculative derivatives, it is hard for even the most experienced investors to stay rational, let alone be clear on whether to buy, hold, or sell. That's why so many experts on Wall Street are giving so much conflicting advice. Okay. Remember, what happens is people are kind of creatures of habit. They're kind of emotional creatures by nature. When things are going bad, it's really bad. Everything up, get out of everything. When it's going up, throw it all back in, baby. It's ready. Remember, we told you in last year we got out of stocks.
In the fall.
But I am in 25% stocks now, and that's still a little. Don't get me wrong, I've missed out a little bit of this gain, right?
Yep.
This little gain the last month or so, but it's still, those PE ratios and all that are still higher than they were in 2000 or 2007 when it went down. I see it need a correction.
I was listening to that same show with Harry Dent on there, and different markets, they call different things. You know what they're calling the market now?
No.
They're calling it a bunny market.
What's a bunny market?
They said, was my question. I'm glad they answered that. They said a bunny market is a market that hops around a lot, which means a lot of volatility up and down.
About it. Remember, if the market's averaged this 8-9% a year all these years, it was moving 10% a month lately.
That's right.
I mean, just crazy numbers. But here's another excerpt from that article. At the International Institute of Management, our stock market predictive model flashed a red alert in the second quarter. Now, remember, the second quarter ended high, right? So it's going up, and this is flashing some red alert, but it said it indicated a double-digit decline. If the central bank policies and financial market trends continue, we could see a severe market correction in either 2016 or 2017. And so people don't realize, well, who has said that, did you read somebody that the Federal Reserve really can't do anything at this point? There's not much they can do.
There's not much. And the only tool they have is what? Interest rates.
That's right. And what it's talked about that later here. It said the Fed's decision to leave, interest rates where they are,
alone.
put more weight on inflation. Okay, and if they raise rates, and what they usually do to raise rate is to break high risk consumer and corporate debt in the stock market bubble, because people kind of go overboard either way. It's like somebody told me, I'm buying nothing but rental properties right now. I said, rental properties are fantastic. I mean, you might be able to buy a $100,000 house and rent it for $1,500, $2,000 a month, but they always overdo it. Like I've seen it in Dallas. The real estate market crashed. They were building all these apartments. Then they quit building apartments for 20 years.
Yep.
And now try to go rent a 2-bedroom place in a nice neighborhood apartment. You might be paying $1,500, $2,000 a month or more, because there's no availability, right? Now they're gonna, everywhere you see, they're building the stuff, right? Building houses, so they're gonna have a glut again.
Basic supply and demand.
That's right.
101 economics.
Now, if the Fed were to lower interest rates, increasing the risk of capital outflow, it could cause a major decline in other countries' stock markets because their exports would be hurt. Currency traders will turn on those short positions. Remember those automatic trading algorithms out there?
Oh, yeah.
And that could really fuel a stock market decline.
They were along that line. They were talking about the Fed really is helping Wall Street more than Main Street because the rates are so low and the people in retirement and savings, you and I were sitting in cash, all the other folks out there sitting in cash, you're almost negative a couple tenths of a percent because you can't gain anything. And you take that and you combine that with the fact that they're projecting Italy to be the next Greece as far as the financial industry is really in trouble.
But you look at that, the people don't realize the global Forex stuff, the foreign exchange markets,
right?
They dwarf the stock market,
right?
On how much volume is moved,
right?
And all these algorithms, these computer programs that are now they got triggers in them,
right?
And they immediately can buy or sell billions in a drop of a hat. I mean, right there, you got $5 trillion a day. Remember how big a trillion is, right? Remember our deficit's about to get to 20 trillion,
right? 19.
$5 trillion a day. It's huge numbers. That stuff can sink, countries, but all of those kind of things. And they said, what if they cut interest rates? There's all kinds of things. They said central banks are in a bad place. If they raise interest rates, that's bad. If they lower them, it's bad again. And so there's not a lot you can do in there. Okay. Also, there's a 10 trillion in corporate debt that is about to due us, and 3 trillion of it is high risk debt. And a risky debt of $3 trillion can impact the U.S. financial markets, whether the Fed will admit it or not. But add that to the derivative markets we talked about. The derivative markets up to $40 trillion, and you got a real problem there. Stay with us, folks. I got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense.
Welcome back to the show. Remember, if you have any financial questions or like to take advantage of our no-cost, no-obligation retirement plan, retirement stress test, and Social Security Optimizer, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. Or go to ilovemyretirement.com.
Yeah, and tack on to that little caveat. A lot of times, other than showing you, which we've talked about, how long your money will last and how much you'll have at 84 and 94, some of the really neat things, at least I've been able to do with clients, I'm sure you have, Victor, too, is it helps organize and clean up and simplify. I mean, diversity is good. You need to be diversified, but sometimes there's a lot of little IRA accounts and 401ks, some things that can be consolidated. You may have different pensions out there. You're not quite sure if you got to be 62 or 65. They have different rules. If you qualify at 62, it does you no good to wait to 65 because the number's the same. So you want to start that at 62 regardless, perhaps. But it really gets all of that stuff down in front of you. You can get your pension sorted out, consolidate some of the stuff, make it easy to read, reduce some of the statements. I mean, there's a lot of great benefits from it.
Also, there's things like, typically retirees will spend more the first 10, 20 years of retirement.
Absolutely.
And so having a little more cash flow then, if you're traveling to Europe and et cetera, might be a better thing. And so you can actually design a plan with a little more front-loaded cash flow. And so remember, don't hesitate. We'd be more than happy to provide it to you. 972-715-2424. ilovemyretirement.com. All right, let me wrap up this one. This was in Market Watch. It was talking about why this market rally looks like a classic investor trap. It's talking about all this, trading systems and these algorithms out there that really just can do trillions of dollars in a day in markets. Because it said add the debt that's coming due America in the next few months to the derivative markets. I'll put that risk in perspective. The size of the global stock market, all the stock markets of the world, is about 30 to 40 trillion, right?
Total.
20 trillion is the U.S. So that's how big our market is in comparison. But if you take the derivatives markets, remember that's futures bet on bonds, commodities, stocks, it's estimated 800 trillion. So you're talking about 10 to 20 times more than our U.S. stock market is this derivative market betting on the markets.
That's right.
And so that's why the fundamentals won't matter in a situation like that.
And they're coming up with new ways every day to do a derivative.
Right. And derivatives different. It's not like a stock market where you're buying into ownership where it can go up and back. It's a zero-sum game. You got a winner and you got a loser. And that's why they trade so quickly. You'll see, what's that? There's a new movie out. Well, they shorted the market because they saw it topping out.
Oh, I don't know the name, but I know what you're talking about.
But the conclusion is you got to accept that central banks have reached a limit. If conditions remain the same, annualized stock returns for most investors will be single digits at best, and more likely be negative double digits. Investors be wise to take measures how to preserve capital rather than invest aggressively at every market dip like they're doing now. And so that's just one opinion, but it had some pretty good meat to it, so I thought I'd share it with you. Now,
and it usually, these type of things, when it's a dead cat bounce, however you want to phrase it, when the market starts going up and you get, again, it's emotional and it lures people in. And, unfortunately, the longer that growth is, it lures more and more people in that probably shouldn't be in, meaning age and retirement and such.
So this is what we do. We answer your financial questions. Anytime I find a question from an investor, a listener, someone, they come in by email or in person, if I think it's going to be, if you could benefit from the shared audience, I'm going to share it with you. All right, Guy, what's our first question today?
Well, we've been talking about the deficit. Let's start there. The deficit will hit $20 trillion, which will cause massive inflation and currency devaluation. I'm buying precious metals, mainly silver, to protect myself. What are your thoughts?
Even though that 20 trillion figure affects me, didn't Obama say when it was 10 trillion that should have been Bush sitting in jail or something?
I think so.
But now that it's 20, it's okay. Now that he's effectively doubled it, it's okay.
It's okay.
He shouldn't go to jail, but the guy before
wait till Sanders gets in there.
Believe it or not, they don't have as much to do with each other. Usually, to me, that's more fear mongering. Somebody trying to sell you silver, gold, or some report on silver and gold. And remember, Dillon Gage, a company we're affiliated with for many, many years, they're one of the largest precious metals dealers in the world. And I'm not telling you to buy all precious metals. They just don't have that much of a thought. Think about it. If you'd taken your back a few years ago when it was 5 trillion, they were telling you then it's going to cause massive inflation. When it was 1 trillion, I remember when it turned to 1 trillion, oh my gosh, this is going to be the end of the world. That was many years ago, and we don't have massive inflation. Gold hasn't gone up. They say, well, it always goes against this. Well, in the old days, maybe it went against the stock market or against some kind of, valuation of the economy. It doesn't anymore. It moves on its own. Gold could be $4,000 an ounce next year, and it could be $300 as well. And we'll talk about that more when we return from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's
welcome. We're going over your questions right now. And remember, if you have a financial question you'd like answered on the air or in person, don't hesitate to call our hotline, 972-715-2424. You can go to ilovemyretirement.com.
Before the break, Vic, you were talking about gold, asking the question about the debt, the national debt, and should we buy metals and stuff. You and I have run the numbers, I think, back to the turn of the century. Not the recent one, but the one prior. And, gold is like the stock market. If you've had it for certain periods, you could do real well. If you had it for other periods, not so much at all. But I think the long term, I wish I had the numbers in front of me, but it wasn't very good.
I think you can't relate it to anything anymore. Most of those are selling you gold or some newsletter
Absolutely.
about gold or whatever, or how hard assets are so much better than paper assets, whatever. But the truth is, you can't find much of a correlation anymore in anything. It doesn't really track anything. The only thing that I've been able to find that it does seem to track some is a fear gauge. When people are fearful, gold goes up. It's kind of a self-fulfilling prophecy. They'll start buying more gold, right?
Yep.
If consumer confidence is high, gold goes down. And so there's really I can't find any correlation, not a logical correlation between the two.
It's a little bit like real estate, though. How many times we've worked with the people that are in the real estate business, they love the real estate because it's tangible. They can see
That's
it.
right.
They can go out there and put a new gutter on it and do.
Right.
I think gold's the same thing for a lot of people. I think it provides them some security to have that bag or those bars and have them in their possession, in their house. Don't really know if we got into a apocalyptic deal where you can take those bars because people are going to want food or something else in trade, right? They're not going to really want gold, which is the reason to stockpile gold. But it gives you, I guess, some security to have it.
I mean, I know a whole lot of real estate people. The one thing about them is a lot of times, man, they put it all in real estate, no matter what.
Yep.
All of it.
Oh, yeah.
And I've always tried to explain, you might want to have something outside of real estate that makes interest or revenue beyond that particular industry just in case. And you can say it every time, and they watch it go up. They get rich on the up, poor on the down.
Yeah.
But that's what it is. All right, what's our next question?
All right. Not quite sure. Let me take a look. Oh, this looks like a long one. All right. I've listened to your show for many years, and I kind of get the idea that putting a portion of your money towards a guaranteed income stream to ensure families don't run out of money. My main concern with that premise is that I don't think the guaranteed payment will keep up with inflation. $5,000 per month in income now won't be worth as much in 20 years down the road. Do you have anything that can give me a guaranteed payment but also address the inflation issue?
Yeah, there's actually been some real breakthroughs in that industry, in the guaranteed income industry here in the last probably year.
Oh, yeah.
Where some of them will give you a guarantee of, say, 2 to 4% increase in your income to help you with inflation. Others will have the one that intrigues me the most is you're going to get an income stream, and it's going to be more than likely higher than bonds, higher than CDs, higher than any kind of income dividends, higher than any kind of income stream you get. Plus, every time an external index goes down, a lot of them are using the volatility control S&P indexes. If it goes up 4%, you get 4% increase, and that's a new step up. Now, for life, it can't be more than that 104%.
Can't be less than.
That's right. And so the next year, if it went up 10, you get a 10% raise. If the market goes down 20 the next year, you still stick at that 104 plus the 10. And so that's a really good fighter, a really good way to fight inflation is to start with a high income stream, and no matter if the market ever has an up year, you get a raise. Think about it, the 2000 to 2010. The market made nothing because the 4 big down years took out the 6 big up years. But they don't take down years. So if you just took a portion of those, I think the worst it made is 4.5% a year. So that's pretty good inflation protection.
The brain tease with that, though, there's a lot of these guaranteed incomes that you can still get now for 6.25% or 7% guaranteed using it for income. And that's going to give you a larger number, and it's going to give you an absolute number. You will have X amount of dollars in 5 years, or in 10 years if you defer to 70, where this will probably start out a little bit lower because the guarantee is a little bit lower, but it can always go up, and eventually the market will go. So you have to decide a bigger number now, but that's what you're going to get. It's a static number. Or do you take a little less now and have that increasing income down the road?
I did an analysis for a person here just the other day. It was, all right, you want 6,000 guaranteed,
right,
or 4,800 increasing. It only took 3-4 years to increase above it,
right?
But that 5,000 was like 15,000 a month in income late in their retirement, and so that's really kept up with inflation. Unless, like I said, you should never address inflation if you truly believe they're going to start lowering your electric bill, they're going to lower your water bill.
There you go.
Your healthcare costs are going to go down, and your food cost. The grocery store, Kroger, is going to start charging less for everything.
Although they're talking about that whole sector now not going anywhere because it's gone up so much.
I'm telling you, the amount of money. I remember when I was a young family. Now I'm an older family guy, right? And I remember groceries. We'd budget about $80 a week, maybe $100 a week, and that filled us up pretty good. We weren't starving. Oh my gosh, my Costco bill is about $2,000 a month, plus another about $1,500 to $2,000. I'm like, we're not eating caviar every day, I promise you.
That reminds me of
It's
the joke
nuts.
of the old timer going to the grocery store. Someone about your age, Vic. And he said, man, I'm getting stronger every year. Used to be I could only carry $10 worth of groceries. Now I can carry 50.
That's right.
Right?
All right, what's the next question? We only got a minute left, but we'll start on this one.
You want to start a question?
Yeah, go ahead.
All right. I've been told by my broker that I should put everything in a target date retirement fund. It sounds logical, but is there anything I'm missing?
Target date funds are those, I think, if I'm not mistaken, Fidelity came up with those. Fidelity 2010, 2020, 2030 funds. And then everybody kind of took off, and then they kind of morphed into a moderate retirement fund 2020, growth retirement 2020, all those kind of things. The concept is interesting. I like the concept, but in practice, it's a little different. How they invest and the pressures they are to get returns are so much that it makes it real difficult. And I'll explain why after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure.
Welcome. Remember, folks, our philosophy here at Dillon Gage is we believe you should, if you have expenses of, say, X, you should insure at least your hard expenses for the rest of your life. No matter what happens to the economy, no matter what happens to the stock market, interest rates, who's in the White House, what's happening globally, your bills are paid. Then the stock market is a great tool to help you cover inflation, some liquidity concerns, all of the other things you might have. But I tell you what, retirement is not only a physical thing, but it's psychological. And knowing that your bills are paid, or knowing that you have positive cash flow coming in every month, just like your bills come in every month, is something so invaluable. And the clients that we have are actually experiencing that right now, are so thankful. So if you'd like I said, no obligation, no cost, retirement plan stress test and Social Security optimizer, never hesitate to call our hotline at 972-715-2424. Again, 972-715-2424. Or you can always go to our website, ilovemyretirement.com.
Another one of those things that does, when you have the hard expenses taken care of, we talked about it probably in the second segment of the show today, emotion and what a killer it is. It takes emotion out of it. If the bills are handled and that's taken care, you're not worried about getting in and getting out.
That's right.
It's handled. It provides security and peace of mind.
Right. The question brought for the break was target date fund. Should you put all your money in a target date fund? Like right now, it'd be a retirement 2020 fund, something like that. And the problem I see with that is I go back to 2008. Remember when the market crashed? The average 2010 fund. Now remember, these are people who are going to retire in like a year and a half, 2 years. Went down 40%. Now, why would a fund go down 40%? Now, they're a little better now. They're not as heavily equities as they were, but they're still strong in equities. Once I get to retirement, I want this thing to manage me where if the market dies the last year before I retire, I don't have to delay my retirement 5 years. But that's the problem I have with target date funds. I would rather do an allocation myself to guarantee that can't happen to me than worry about some general fund just not being too far in equities and lose 40% right before I'm going to retire. And by the way, the people that had all their money in those kind of funds in 2000 did not retire for several years, if any.
And you're still fighting upstream battle with the fees and the soft costs and all those things that can be involved in those funds.
Right.
As you get older, basically, what's the rule? Rule of 100. The older you get, you take your age, you subtract it from 100. If you're 60, from 100, it's 40. So 40% is probably the maximum you should have at risk.
And remember, even though sometimes people don't agree because they're more biased towards stocks, I get that.
Yep.
But try to find me somewhere where some advisor says an 80-year-old should be 100% stocks or a 75-year-old.
How often do we see that?
You don't see it. All right, next question.
All right. That's a short and sweet one. Which Medicare supplement should I buy, if at all?
Let me give you my legal disclaimer. We don't do Medicare supplement policies. That's a government license you're supposed to have and all this stuff. But I can tell you just from my own experience. With my father, he had a Medicare supplement Because what happens is people don't realize they're thinking Medicare is going to get cover all my expenses. Try to find a doctor in North Dallas, Plano, Frisco that will take Medicare only. You're going to have a hard time. The supplement policy that my father had paid for everything, and everybody took it gladly because they know the major stuff's going to be paid by Medicare, right?
Right.
And then let the insurance company deal with getting reimbursed from them because your doctor sure as hell doesn't want to, right? I'm not going to wait 6 months, slow paid, low paid, so they won't take Medicare alone. So the only advice I give, I'm not giving advice on which one. I'd buy the best Cadillac plan you could buy because it's, might be a couple $100, but that's, I'm telling you, is worth gold because I've been through it with my mother and father both before they passed. It's a big deal having that supplement policy on top of Medicare. All right. What's your next question?
All right, next question. Another advisor recommended that I take my 401k contributions, I guess in other words, stop contributing, and invest those dollars into his tax-free retirement system that is guaranteed to make at least 4%. My company only matches 1%, and my 401k doesn't have anything that will guarantee 4%. Seems like a good idea. Your thoughts?
Anytime somebody says tax-free retirement system,
Oh, yeah.
they're talking about a life insurance policy. I don't care what they call it. I remember them calling it a 401e plan, all that. It's a life insurance policy. And here's a quick way to find out. When they say this guaranteed 4%, and you put in $100,000, well, 4% over 10 years should be about $150,000. Ask them to show you an illustration what your minimum return is in 10 years. Is it? And you'll see it won't be 150.
It takes a long time for those policies to get away from the cost of insurance.
No, it might be 80,000.
Yeah.
Because the cost of those policies are much higher than that. Don't give me. Is that saying that no permanent insurance policy you should buy? No, that's not. But anybody that's trying to make it a tax-free retirement system, that it's just not. Don't buy life insurance. But if you need life insurance, buy life insurance. Don't buy it for a retirement plan. Because even if you pay tax on something else, you'll probably end up with more after-tax money because that's how much more the fees on some of those policies can get really, really bad. I mean, ridiculous. So be very careful. Anything says tax, there's only a couple things in the world tax-free, folks. Municipal bonds, right? And if you were living in a state that has state tax, those wouldn't be completely tax-free. Municipal bonds in Texas, the only thing tax-free, or borrowing money out of a life insurance policy. It's not really an income. You're just borrowing money from the death benefit. And there's a lot of pitfalls in that, too. If somehow that policy lapses, you might have to pay a huge penalty and a whole bunch of money to the government because it's not tax-free if that policy lapses ever. And what happens is when you're 80, 85 years old, the premiums get so high, and if you've withdrawn so much, you have to let it lapse.
Absolutely.
So remember, if you have any financial questions, we're here to help. If you'd like to come meet us, call us at 972-715-2424. Again, 972-715-2424. You can always go to our website. There's some great videos on there, ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.